While economists warned of global recession throughout 2023, one wealthy nation quietly maintained unemployment below 4% for over 2 consecutive years. Australia, a country with just 26 million people spread across a continent, consistently outperforms expectations. What's the secret? In the next 9 minutes, you'll discover 10 structural advantages that make Australia's economy remarkably resilient. These aren't surface-level observations. We're examining the institutional design, geographic realities, and policy decisions that compound over decades to create sustained prosperity. By the end, you'll understand why this matters far beyond Australia's borders. And if you're interested in how economic forces actually shape nations, beyond the headlines, subscribe now. We break down complex global economics into clear insights you can actually use. Let's start with the obvious: natural resources. But here's what most analysis misses: natural resource wealth beyond mining. Port Hedland is a remote town in Western Australia with just 14,000 residents. Yet this single location exports $90 billion worth of iron ore annually, more than the entire GDP of many nations. Drive through at night and you'll see autonomous trucks moving under LED lights, 300-car trains stretching into darkness, ships loading around the clock. But Australia avoided the resource curse that's plagued nations from Venezuela to Nigeria. According to the Australian Bureau of Statistics 2023 report, resources contribute 13% of GDP, but that's diversified across more than 40 commodities: iron ore, coal, natural gas, lithium, gold, rare earths. When one commodity price drops, others stabilize the revenue stream. Export revenue hit $450 billion in the 2022-23 fiscal year. The key difference? Australia structured resource wealth as a national benefit through taxation frameworks and sovereign wealth mechanisms. Mining companies pay substantial royalties, income tax, and increasingly are required to process materials domestically. This creates downstream jobs and captures more value from raw materials. Here's your key takeaway: resource abundance only translates to prosperity when paired with institutional capacity to distribute benefits broadly. The rocks in the ground matter less than the governance system above it. But natural resources mean nothing without someone to buy them, which brings us to geography's hidden gift: strategic geographic positioning. Speak with any logistics manager at Melbourne's port, and they'll tell you something crucial. Australia can ship to Asia's fastest-growing markets overnight. When a manufacturer in South Korea needs iron ore, or when a power plant in Japan requires coal, Australian suppliers deliver in days. Their European or South American competitors face 2-week journeys. The Asian Development Bank's 2024 analysis shows that Asia-Pacific markets now represent 67% of Australian exports. China, Japan, South Korea, and increasingly India sit within a critical shipping radius. As the global economic center shifts toward Asia, a process that's been underway for 2 decades, Australia's geographic position becomes more valuable each year. This isn't just about distance. Proximity creates relationship depth. Australian mining executives visit Tokyo and Beijing regularly. Trade negotiators understand regional dynamics intimately. Time zone overlap facilitates communication. These soft advantages compound over decades into partnerships impossible to replicate from another continent. Think of it this way: if the 20th century economy centered on the Atlantic, the 21st centers on the Pacific, and Australia sits right there. Proximity creates opportunity, but capitalizing on it requires something many resource-rich nations lack entirely: institutional stability and rule of law. I spoke with an Indonesian mining executive who processes minerals in Australia despite costs being 20% higher than domestic options. His reasoning? Regulatory certainty. He knows contracts will be honored, property rights protected, disputes resolved fairly. That predictability is worth the premium. The World Bank's 2023 governance indicators place Australia in the 96th percentile for rule of law globally. Transparency International ranks it 14th worldwide for corruption perception. These aren't just abstract scores, they translate directly to business confidence. When companies plan 50-year mining projects or build billion-dollar processing facilities, they need confidence that today's rules will still apply tomorrow. that the government won't expropriate assets, that courts will function independently, that regulators won't demand bribes. Australia provides this certainty. The result? Foreign direct investment flows steadily even when global capital becomes risk-averse. Insurance and financing costs stay low. Long-term planning becomes viable. Your takeaway: stable institutions reduce risk premiums across the entire economy. Every percentage point saved on financing costs compounds across thousands of projects into billions in additional investment. Stable institutions attract capital, but transforming that capital into prosperity requires a specific demographic advantage. Skilled immigration system. Follow the journey of a software architect from Bangalore. She applied for Australian permanent residence through the skilled migration pathway, earned points for her education and work experience, received approval within 8 months, and now runs an artificial intelligence startup in Sydney employing 40 people. Australia's immigration system is ruthlessly pragmatic. According to the Department of Home Affairs 2023 data, 70% of permanent migrants enter through skilled pathways. Not family reunion, not humanitarian grounds, but demonstrated economic contribution. An OECD study found Australia has the highest proportion of tertiary educated immigrants among all developed nations. This isn't about cultural debates, it's economic design. The system identifies labor market gaps: nursing, engineering, IT, trades, and issues visas accordingly. When mining booms created skilled labor shortages, immigration ramped up. When certain sectors contracted, visa allocations adjusted. The result? Australia's population grew from 17 million in 1990 to 26 million today, with most growth coming from working-age migrants bringing skills the economy needs. This solves the demographic decline crushing Japan and parts of Europe while maintaining wage growth because skills match demand. Key insight: strategic immigration fills labor gaps while driving innovation, creating population growth without the social strain of unskilled migration overwhelming services. It's not about more people, it's about the right people arriving at the right time. But importing skills only works when paired with something most nations struggle to maintain: educational infrastructure excellence. Visit any research laboratory at the University of Queensland, and you'll find international collaborations spanning 5 continents. Publicly funded research enables world-class work in marine biology, medical technology, agricultural science. Students pay relatively modest fees compared to American counterparts. The government subsidizes education as infrastructure investment. The QS World University Rankings 2024 places 7 Australian universities in the global top 100, remarkable for a nation of 26 million. This creates 2 economic benefits simultaneously. First, the international student sector generates $36 billion annually. Students from Asia pay full tuition fees, supporting the university system while experiencing Australian education. Many stay permanently, joining the skilled workforce. It's immigration pipeline and export industry combined. Second, strong universities drive research commercialization. University partnerships with industry create pathways from laboratory to market. Australia leads in medical devices, mining technology, agricultural innovation, sectors where research excellence translates to commercial advantage. Here's what matters: education functions as both economic driver and soft power tool. It builds domestic human capital while generating export revenue and strengthening regional relationships. Few investments pay dividends as consistently. Education creates capability, but economic resilience requires one more critical element, one that saved Australia when others collapsed: banking system resilience. September 2008. Lehman Brothers imploded, triggering global financial crisis. Banks failed across America and Europe. Credit markets froze. Yet Australia's banking system never collapsed. Not one major institution failed or required government bailout. Why? Boring regulation. The Australian Prudential Regulation Authority maintained conservative lending standards. Banks held higher capital reserves than Basel Accords required. Mortgage lending required genuine deposits, no subprime nonsense. When global crisis hit, Australian banks weathered it. Reserve Bank of Australia data shows the result. continuous credit supply to businesses and households through the crisis. The economy entered technical recession briefly but recovered faster than peers. Housing prices dropped moderately, not catastrophically. The lesson here challenges conventional wisdom. Conservative banking regulation sacrifices short-term growth for long-term stability. Australia's banks are profitable but not exciting. They don't innovate aggressively or take massive risks. They're boring. And when exciting banks globally were collapsing, boring succeeded. Your takeaway: financial stability enables everything else. Without functioning credit markets, the real economy stops. Australia protected this foundation when others let it crumble. Financial stability enables something that distinguishes Australia from peer economies, a system most nations abandoned decades ago. Mandatory superannuation system. Meet an electrician working in Perth suburbs. Every month, his employer contributes 11% of his wages into a retirement account he can't touch until age 60. He didn't choose this, it's mandatory. Over a 40-year career, these forced contributions compound into substantial retirement savings. Multiply this across the workforce. Australian Bureau of Statistics 2023 figures show superannuation assets total $3.5 trillion, representing 140% of GDP. This is the world's fourth largest pension system for the world's 55th largest population. This creates two powerful effects. First, it builds wealth equity. Working-class Australians accumulate assets that generate returns. The electrician who never invested actively still owns shares in Australian companies, infrastructure projects, global markets through his super fund. Second, it provides stable long-term capital. Superannuation funds invest in toll roads, airports, renewable energy projects, infrastructure requiring patient capital. The OECD notes this domestic capital pool insulates Australia from global financial volatility while funding productive investment. Key insight: forced savings solves two problems simultaneously: retirement security and capital formation. It's economically elegant even when politically controversial. Domestic capital provides foundation, but economic flexibility requires controversial policy choices about labor markets. Flexible labor market dynamics. Consider automotive manufacturing. Australia produced cars for decades. Ford, Holden, Toyota operated factories employing thousands. When production became uneconomical in the 2010s, manufacturers closed. Workers lost jobs. Communities struggled. But here's what happened next. Government retraining programs helped workers transition to renewable energy manufacturing, healthcare, construction. The unemployment rate in former manufacturing towns spiked temporarily but recovered within 2 years. Workers moved between industries and regions. The OECD Employment Outlook 2023 ranks Australia high for labor market adaptability. Unemployment recovery after COVID-19 outpaced comparable economies. Why? Australia balances worker protections with employer flexibility. Companies can adjust workforce size when economic conditions shift. Workers receive support during transitions but aren't locked into dying industries. This matters more than it seems. Many developed nations protect existing jobs so aggressively that structural change becomes impossible. Coal regions fight to preserve mining long after it's economically viable. Manufacturing sectors demand tariffs, maintaining uncompetitive production. This protects today's jobs by preventing tomorrow's opportunities. Australia makes the opposite trade-off. Allow structural change, support workers through transition. It's politically difficult, displaced workers vote, but economically necessary. Your takeaway: labor market flexibility allows the economy to evolve without sustained unemployment. Workers move, industries adapt, and overall prosperity increases even when specific sectors decline. Economic adaptability matters little without the resources to fund it during crises, which brings us to a capability most nations lack: countercyclical fiscal capacity. March 2020. COVID-19 forced lockdowns globally. Businesses closed, workers stayed home, incomes evaporated. Australia launched JobKeeper, a wage subsidy program supporting 3.6 million workers at its peak. The government paid businesses to keep employees on payroll even when revenue disappeared. Total cost? $311 billion in pandemic support spending. That's 16% of GDP deployed to prevent economic collapse. Most nations couldn't do this. According to the IMF Fiscal Monitor 2023, Australia entered the pandemic with a debt-to-GDP ratio of 45%. The OECD average was 88%. This fiscal space, accumulated through decades of relatively conservative budgeting, enabled massive crisis intervention. Nations with high existing debt faced impossible choices: support the economy and risk fiscal crisis, or maintain fiscal discipline and let unemployment explode. Australia avoided the dilemma because it had room to maneuver. Here's the paradox. Fiscal conservatism during good times enables necessary spending during crises. Running smaller deficits when the economy grows creates capacity to run larger deficits when the economy contracts. It's countercyclical policy actually working. Key insight: low peacetime debt isn't about austerity. It's about maintaining emergency capacity. The real cost of high structural debt isn't the interest payments. It's the lost ability to respond when crisis hits. But all these advantages mean nothing without one final, often overlooked factor that ties everything together: continuous economic reform culture. Travel back to 1983. Australia's economy was struggling. High tariffs protected uncompetitive industries. Fixed exchange rates distorted markets. Government-owned enterprises operated inefficiently. Then something remarkable happened. Both major political parties embraced reform. Labor governments floated the currency, reduced tariffs, opened financial markets. When liberal national coalitions took power, they continued, privatizing airlines and telecommunications, restructuring taxation, modernizing labor relations. This bipartisan acceptance of evidence-based policy drove transformation over 2 decades. The Productivity Commission, an independent government agency, reviews economic policies and publishes recommendations publicly. Politicians can ignore advice, but they can't hide it. This institutional pressure toward evidence-based reform is unusual among democracies. OECD economic surveys consistently cite Australia's reform responsiveness as exemplary. The structural reforms from 1983 to 2003 added 2.5 percentage points to annual productivity growth, according to Productivity Commission analysis. Compounded over decades, that's the difference between stagnation and prosperity. Here's what this really means. Australia demonstrates political willingness to make unpopular changes before crisis forces them. Floating the currency hurt import-competing industries. Reducing tariffs cost manufacturing jobs. Privatization was politically toxic. But avoiding gradual decline required accepting short-term pain. Your takeaway: reform culture compounds over decades. Nations that continuously adapt maintain advantages, while those that resist change accumulate problems until crisis forces painful adjustment all at once. These 10 strengths don't operate in isolation. They reinforce each other in powerful ways. Resources generate wealth, but institutions protect it from extraction. Immigration expands economic capacity, but education maximizes potential. Banking stability preserves gains while superannuation deploys capital productively. Labor market flexibility optimizes resource allocation while fiscal capacity defends against shocks. And reform culture renews the entire system continuously. This is the compounding effect of good policy decisions. No single factor explains Australia's success. The combination creates resilience that weathers shocks devastating to other nations. Now, let's be clear about limitations. Australia faces serious challenges. Housing affordability is creating intergenerational inequality. Climate change transition will cost hundreds of billions and requires closing coal industries. Economic dependence on China creates vulnerability to geopolitical shifts. Indigenous Australians still face systemic disadvantage despite recent progress. These advantages don't guarantee continued success. They create favorable conditions that require wise stewardship. The question isn't whether Australia has problems, but whether its structural strengths provide capacity to address them. Looking forward, these 10 factors position Australia well for the Asian century. Geographic proximity to growth markets, skilled workforce, stable institutions, and flexible economy create significant advantages. But only if political leaders maintain reform momentum rather than coasting on past success. Australia's economic success isn't luck or natural resources alone. It's institutional design, geographic fortune, and decades of policy choices compounding into resilience. So here's my question for you. Given these 10 structural strengths we've covered, which factor do you think matters most for economic resilience? Or flip it around, despite these advantages, what vulnerability should Australia worry about most? I'm genuinely curious about your analysis, so share your perspective in the comments below. And if this breakdown gave you new perspective on economic fundamentals, the institutional factors and policy choices that actually matter, subscribe for everyday analyses that go beyond the headlines. We examine how geography, governance, and human decisions shape national prosperity in ways news coverage misses. Thanks for watching. I'll see you in the next one.